or maybe it was their fault because they changed the default settings. Anyway, good morning, happy Friday. It's January 20th, 2017. This is part 2 of our tax projections, tax return analysis series. And this time we're going to break down the tax forms for everyone. And before I even do that, I want to show you all something that we started creating. I'm going to bring something up on my screen and then share it. This is, in our 97 and up group where we meet twice a week. And we have calls to go over lots of different things. We started developing a tax engagement checklist in Smartsheet. Nicole helped us create it. Mariette, I know that you have something that you use, so I'll be curious to see what your input is on this.
Stop.
Let me share my screen.
Stop.
Stop. Who said that?
Good God, that's tiny.
Is it? All right, where's Adam Sivak? Adam, are you here with us this morning?
I think I am.
So is it small?
Oh, yeah, it's small.
The screen is small?
The screen is so small right now.
It's okay. I zoomed it on my iPad. I'm good.
Okay. Anyway, so Mariette, are you still there with us? Did we lose you?
Why is it so small?
Yeah. No, let's keep going.
Okay, so this is the tax engagement checklist that we started to develop. We kind of broke it up into 2 major sections, onboarding and then the actual engagement. And we just started kind of listing all of the things that, on a typical tax engagement you might need. So, within that, we've got the engagement letter. It's sent, it's signed, and signed copies received. Then we send out the client use agreement, signed copy of that is received, and then we have documents needed, and we broke it down in terms of business and personal returns, right? So, and like I said, Nicole helped me develop this with our 97 and up group. So, this is something that's available to members to get access to. But Mariette, what does yours look like sort of in comparison with this?
Yeah, mine's definitely different. I'm trying to pull it up right now and trying to get some stuff off of it. But mine is essentially built off of trying to look here. So what happens in my workflow, especially from, if we're going to talk about like books to tax, the idea. So let's just say I'm dealing with a small business owner, a self-employed person. So they actually really start more with an actual letter. So it's an email through 17 Hats, which has an attached checklist in it. And the exciting part, we were talking about this before we fixed the issues, Adam is working with ShareFile, and I think you are too, Seth. But I'm going to start using the workflow, ShareFile workflow, which allows you to import a checklist, and then that checklist gets sent to the client. And basically, it's kind of like a workflow between you and the client when they're uploading their documents into the ShareFile. So they just get really like an Excel spreadsheet. But now it's going to be a little bit different because it's going to be in a ShareFile, the new ShareFile workflow, which is more like an email, like a one-time email that they get with all the documents that they need. So obviously, if a QuickBooks file, depending on what kind of income they have, if I need specific source documents related to their sale, to their expenses, on a personal note, because obviously the business returns flow into the personal return. So then I would be asking for personal transactions like, W-2s, mortgage statements, property tax statements. So it's really more in very close to like a Smartsheet idea, but it's really an Excel that gets attached to a 17 Hats engagement workflow that I create. So basically it's, hey, welcome to tax season, let's get started. And it looks a lot like this, but it's more email with an attachment.
I see. Okay. So, and again, building this out in Smartsheet, the idea, of course, is that we have a lot of date-based stuff that we can set up, and then we can create the alerts. That's what I love about Smartsheet, most of all, when it comes to workflow stuff like this, is that I can use date-based things to then trigger reminders based on those dates. You can do it relative to any date, right? So I can say this is based on a start date. So I can say, send me a reminder 7 days before the start date and say, make sure you're prepared to get whatever it is that you need, right? And then obviously the choice is for start date or due date, it's picking this from the columns that I've created that are date based. Or I can say, send me a reminder on a specific date, right? That has nothing to do with the date assigned. And also it's right by default, it's sending it to me, but I can choose to send it to all the shared users in this worksheet. The other thing I could do is I could create an assigned to column. Where is it? Contact list. And this is probably mostly how I would use this kind of thing. And that way, when I go to create the alert, let me save that. That's going to be one of the choices. If I scroll way down here, I can just tell it, send it to whoever it's assigned to 7 days before the start date. Save that, and then I can create a new reminder and say again, send it to whomever it's assigned to 1 day before the start date. And then what I could do is, let's say I'm the person reviewing the work. So, let's say you have a practice where you have people working for you. Then what I can do is I can say, send it to me 1 day after the due date. So this way I get reminded a day after whatever the due date is to, log in and check. And I love this because Smartsheet will send me an email. And believe me, I get 400 emails a day, but I don't mind getting these because it'll sit in my inbox unread, or I'll star it knowing I have to get to it that day. Sometimes what I do in the morning when I get these kind of reminders is I immediately click through and open up the tab in my browser and then delete the emails. The emails are what I call throwaway emails. There's no reason under the sun why I need to save these email reminders. They're just a trigger for me to go in and make sure I follow up on something that day so I don't drop any balls. So anyway, I wanted to spend a couple of minutes at least kind of showing you all. This is kind of, I was trying to start to develop the tax engagement equivalent of that monthly bookkeeping checklist that I went over a few weeks ago that we created. So anyway, this is, if you're wondering what we do in 97 and up, this is the kind of stuff we do. We work on things like this, things that really can help us with our businesses and things that can help us, optimize and organize workflows and all that sort of thing. So, but now we're here to talk about tax returns. So let me save this. And I brought up, I don't know, Mariette, did you have anything like an example prepared? Otherwise, I just, went to the forum on irs.gov. Mariette, did we lose Mariette? Uh-oh.
I don't see her in the queue.
Yeah, I don't see her in the queue either. Oh, I thought I went radio silent again with all of you. But all right, no, at least so you can all hear me?
I can hear you.
Okay. So something happened to Mariette. Okay, well, I'll keep going. Unless Chris, do you want to chime in? Chris Reagan, you there?
I don't think is he? Oh, yeah, he's here.
You, but he's muted and video off.
I'm here.
You're there.
I'd hate to take over for Mariette.
I don't. We're not necessarily taking over, but just filling in or just joining alongside us. We're glad you're here.
Mariette, back to you.
What's that?
Oh, nothing. Just nothing.
So, all right. Well, Chris, feel free to chime in because I know you're a bit of a tax expert. So, and Nicole, you as well. Any of you, Dennis, any of you who do taxes, chime in and stop me. So what I did in the meantime was I brought up, obviously we can't bring up somebody's real tax return. I thought about using my own, and then I was like, nah, maybe not. So here's the 1120S. I figured we'd start here. And if you're an LLC, and again, correct me if I'm wrong because I'm not a tax expert. So if I say anything wrong, please stop me and correct me. I don't want to give out the wrong information. I'm going to share based on my experience and understanding of things. So if you're an LLC, you're going to choose to file as either a corp or a partnership, right? And then, Chris, help me understand how that works. If I'm an LLC and I elect to file as a corp, do I then file the S election as well, or do I go, like, how does that work?
Yeah, back in the day, we used to have to, because an LLC by default is a partnership, unless it's single member and then it's a disregarded entity.
Right.
But, if you've got multi-member LLC situation, we used to have to file an 8832, and then we'd have to do a 2553. The 8832 would convert it to a corporation, and the 2553 would convert it to an S corporation. That's not the case anymore. You now just have to do the 2553, and essentially you become an S corporation. 96% of the small businesses in the country are S corporations.
Right.
So knowing this form is much more important probably than knowing many of the others. Now, as we're on Inauguration Day, the C corporation may become more popular later if tax reform is done in such a way where the C corporation tax rate gets knocked down. But for now, 2553 converts you. I typically don't start a lot of LLCs. I typically start them as a corporation. LLCs usually are more expensive than regular corporations are to file at the state. So if they're going to be an S corp, I generally start them as a C corporation, as a regular Inc. or incorporated, and then just file a 2553 and convert them to an S.
Right. That's how I had actually set up my own company as an S corp. In California, the only reason usually that we set up LLCs for clients is if they own real estate, because I think owning real estate in an S corp, at least in California, and I believe it might be state by state, creates challenges. Where so that's
right. I would if you're talking about a real estate holding company of any kind, you want to stay away from the S corporation for a number of reasons. Primarily, that it is extremely inflexible on the levels of ownership compared to what a partnership could offer you, where if you want to give away shares of your real estate to your kids, but they can't vote, you can do that inside of an LLC, whereas inside of a corporation, and especially an S corporation, you can't have multiple classes of stock. So real estate, stay away. Operating entity, services, that kind of thing, S corp's great.
Right. Okay. So now I want to break down the tax return forms, especially for bookkeepers or other accounting professionals who just don't do taxes and may not be familiar with the forms. And this came up within the last few weeks because I suspect it. I've seen it. I obviously talked to a lot of people in our profession, and people have confirmed that A, they're not that familiar with the tax forms, and or B, they're kind of overwhelmed or intimidated even by them. So I thought I'd break it down real simply, and I'll share a quick story of my experience with this and how I started to become real familiar with the tax return forms. And as with many things, in fact, it's a similar story that I have in terms of how I got really intimately acquainted with the statement of cash flows and what that looks like and how that works. Similar kind of experience working with a CPA firm, and kind of thrown into situations where, they would give me clients to work on for financial accounting, and the first thing they'd tell me is, hey, the retained earnings don't tie. So I need you to go through and get the retained earnings to tie. And I said, well, how on earth am I going to do that? And, at the end of the day, I had to start going through the tax return form and breaking down what's on the tax return and comparing that with the trial balance from the QuickBooks file. And that's how I developed my trial balance adjustment template. And in the process of developing that template and then using it to adjust companies' books to force them to agree with their tax returns, I started to become really familiar with this form and how it breaks down. So I'll start with my quick kind of high-level overview, and then, of course, we can dig in a little deeper. It looks like Mariette is back with us. Mariette, you there?
Yeah, sorry. I feel like it's Friday the 13th, but it's the 20th.
That was last week.
Yeah, I know.
So this is the 1120S, which, of course, is the S Corp tax return form. Like Chris said, Mariette, I don't know if you were back with us by then. This is, Chris, you said it was 96% of businesses out there are S Corps?
That's right. 96% of small businesses as categorized by the IRS are S corporations.
That's fascinating. So, all right, so I picked the right form to start with. So this first page of the form, essentially think of this as the profit and loss statement, because that's the information essentially that's on here. It doesn't look like a P&L from a QuickBooks file, but if you break it down, that's the information that's on here. We have our gross receipts or sales. We have returns and allowances for retail type companies, right? We have our cost of goods sold on line 2. The difference gives us the gross profit, right? Then we have a net gain or loss from form 4797, line 17. Chris or Mariette, give me the 30-second version of what that is.
Mariette, do you want me to?
Go ahead, Chris. Do your magic. Your S-corp magic. Go ahead.
So anytime you're selling some kind of business asset where you need to report a gain on the tax return, it's going to flow from the 4797. It's a way to differentiate between assets that have capital gains versus ordinary or other section type gains that were business assets. So it's basically, I sold a truck for a profit, which, you know, sometimes will happen if your basis is zero. So if you decided to depreciate your truck the first year you bought it, and then you sold it for $10,000 3 years later, you may end up with a gain here in 4797 because you literally expensed the whole thing in the first year. That's kind of what you'll see there.
Okay, so bottom line, that's for the sale of an asset and any gain or loss that might have been produced by that. And that's what goes here. So again, it's not exactly mirror imaging your P&L from the books, but your P&L should somewhere reflect that same gain or loss, right? So again, if I'm comparing this to somebody's books and I see this, excuse me, I'm going to want to go find out. And I want to, again, if my goal is to get the books to agree to the tax return, then that absolutely is going to need to be on the books. I need to be somewhere hope that somebody actually recorded the disposition of the asset, you know, credit the fixed asset, debit the accumulated depreciation for that asset to recapture it for the purposes of getting that off the books as well, right? And then we're going to debit or credit any gain or loss on the disposition of that asset. So that number, that gain or loss, or if there's more than one, somewhere in the details, you know, well, the total of it all should match to this.
Seth, I just want to mention something here because, again, coming from explaining this for bookkeeping professionals. So remember that when we're talking about, an asset, or people think about something that's tangible, right? There's different types of inventory items or different type of things that we sell that are tangible, and they could either be assets or they could be an actual inventory item that we sell. The only reason why I want to bring this up is because I'm working with a client that's a flipper. She sells homes. She rehabilitates homes and sells them. And so I had explained to her that her actual home was inventory. She fixes it up and she sells it. So, a lot of people think, oh, well, they sold the home. Wouldn't that be a capital transaction? Well, in the case of a dealer, a real estate dealer, that's actually considered the sale of that home, and the transactions would be like any other ordinary transaction. So the sales proceeds would be gross receipts. The actual home would be considered inventory. So that per se would not be considered a sale of a capital asset. So you just got to be careful because it's very specific to the actual company. So where some company, a sale of an actual real estate would be a capital sale. For another company, maybe they're in the business of selling homes, and so that would be an ordinary sale. So you got to be really careful with that. Incredibly careful if it's a someone that's not an entity and they're like a Schedule C, because there's some serious ramifications in regards to how they report that. So be really careful with that because one way we sell something could be different from one person to another.
Right. And for that matter, and in the bigger picture, if you sell something for a living, if that's what your primary function as a business is, that thing is inventory, period. That's, I think, a really good way to kind of set a barometer for what might be inventory versus what might otherwise be a capital asset. So like Mariette said, if you're in the business of buying and selling real estate, not a broker, but the actual owner who buys the house and then sells it, then like Mariette said, those homes are inventory. They're not capital assets. All right, so let's keep going. It's very well known. We see this discussed a lot in our groups that officers of S Corps have to derive a salary from that corporation, and this is where the total of that salary goes for the year. So that's why on the P&L and the QuickBooks, you'll always see for an S Corp, for sure, where we have to separate officer salaries on its own line. The reason for doing that is because that way we have it right here so that the person preparing the taxes doesn't have to go digging for it, right? So that's why this line item right here is precisely why we separate officer salaries in the P&L for S Corps, because it has to be shown separately. And then this gets us into that whole conversation, which we're not going to get into today because it's not the purpose of today's discussion. Excuse me, but this is where we get into that whole conversation about reasonable compensation and how much do they have to pay as a salary versus distribution. And it's a bit of what we discussed last week when we looked at the tax projection template and we looked at Tax Planner Pro, and Mariette also showed us the QuickBooks Self-Employed module that's there for the same purpose. So although I wouldn't imagine QuickBooks Self-Employed would be somebody who would be filing an 1120-S. It's just not the purpose of that version of QuickBooks.
Seth, I want to mention something really quickly about salaries here, and this is again from the book to tax idea. So there's going to be areas when you're going over a tax return with a client, and this is coming from the aspect that, again, as a bookkeeping professional, you should be able to prepare that client on, with the idea that we got to get your books ready in QuickBooks because it's going to eventually fall onto this page 1 of the 1120S. And then if they're like, well, what do you mean? You can do exactly what Seth is doing. You pull up the 1120S, just, Google 1120S, and then explain it to them. Well, like, for instance, I'm looking at your QuickBooks, I'm looking at your salary, payroll expenses, and that's going to go on line 7 and line 8. So this is really important, guys. So they're like, oh, really? Okay. And then you're like, so where's your compensation of officers? That's kind of like where the conversation starts. But not only that, they could have been paying themselves compensation, but depending on how they were putting in payroll, whether it was like through a journal entry or an automated, service kind of importing it, they may not be splitting compensation of officers with salaries. But as you can see, it's very clear. It has to be split here. So this is your conversation to the client. Hey, you know what? I got to go ahead and do a payroll reconciliation for you where I got to go ahead and separate 7 and 8. I'm going to go ahead and reconcile your quarterly returns with your 7 and 8, make sure all the numbers match. So when it does flow to the tax return, it's going to be a beautiful thing because your tax preparer is going to say, oh my gosh, those numbers tie perfectly to your QuickBooks, and it's all going to be because the bookkeeping professional did their job.
Right. And so if you get to the end of the year and at the end of the day they didn't break it out, then obviously you can defer to the payroll reports, or you just grab the W-2 for the officer and look what the total is there. So if you need something quick to do. But again, as I pointed out and Mariette further confirmed, this is why we need to separate the officer's salaries. And then all the other salaries and wages go here. The other thing that I've found clients get confused about, especially the really inexperienced ones, is they think that because they wrote themselves a check, that's payroll. I've seen many cases where they really wrote a check, which is essentially a distribution, and they put payroll on the memo, and they think, okay, I paid myself payroll. They don't understand necessarily, so don't assume that they understand that payroll means it actually went through a payroll process where withholdings were taken out and taxes were paid in. So sometimes you have to break it down that simply for the client. That there's payroll and then there's distributions. So that distinction is important to be made. And then as you can see, there are certain, I guess, what you'd call key expenses as regarded by the IRS that also have their own line items on the tax return. So repairs and maintenance, bad debts, rents, taxes and licenses, interest, right? Then we have depreciation not claimed on Form 1125A. So again, Mariette, give us the 30 to 60 second version of what Form 1125A means. Remember, I don't want to get too deep into the weeds because I want to cover the whole form first. Then we can go back and dig in deeper on some of this.
Well, are you referring to or on 1125? Actually, that would be the cost of goods part of it. So it's kind of two different areas here. Actually, Chris, you want to take this one?
Sure. So in cost of goods sold, depending on how a manufacturer is booking things, you can end up with depreciation that is part of COGS, which is up on line 2. So this line item is saying we want the depreciation that's not part of COGS, the depreciation on the fixed assets that are what we're all used to, the desks, the computers, that kind of thing. Something that I am a big believer in, and this is why from a bookkeeping perspective, depreciation should not be something that's kind of glossed over as a tax item. I believe you will do a much better job for clients if you are booking depreciation in financial statements so that they can see it. Now, I tend not to put depreciation in the regular operating expenses. I tend to put it as an other expense so that they can see what they really made versus what their taxable income is. But this is something that would tie out to what your book depreciation would show if you were using tax basis for your depreciation. If you're using book basis for your depreciation, this would show tax depreciation. Then you would actually have to make an adjustment in the M1 schedule for the difference between book and tax. But most outside bookkeepers that I've really ever worked with, whenever they brought in financials to our firm, depreciation wasn't really something that was on there except for accumulated depreciation that was shown in prior year tax returns. So as something to provide more value, as a way to make that client realize they can't do this without you, booking depreciation is something that's kind of complicated for an ordinary user. That's something you can do for sure on your own.
Yeah, and I've seen most bookkeepers that I've worked with, and myself included, we wait for the depreciation entries from the person who's preparing the taxes, because it's rare that I've found for a small business that there's a need to keep track of like straight line depreciation separate and apart from the tax basis depreciation. So what you could do, though, I think, is, especially if, as the bookkeeper, you start to develop a good relationship with the CPA or the enrolled agent who's preparing the tax returns for your client, is try and work with them and get the client's approval to do this, because there may be a cost involved, to get a monthly depreciation entry. This way, because when I look at companies' books, especially from kind of a CFO standpoint, I want to see those monthly entries because I want it normalized. I want to see month over month, what did it truly cost me to operate this business? So again, monthly depreciation is the best way to go from a financial analysis standpoint, and then at the end of the year, you would do some kind of a true up to make sure that the monthly adds up to what the tax preparer's actual annual depreciation entry is. And then, like Chris says, if for some reason you have a business that has a need to calculate a book basis of depreciation other than tax basis, such as straight line, which I think is what most people would wind up using in a case like that, then you'll have to book that. And like Chris says, then they have to do a Schedule M1 adjustment. And Schedule M1, for those of you who aren't familiar, is exactly like Chris said. It accounts for differences from books to tax. And so that's something that as the bookkeeper, you really shouldn't ever have to deal with, but you should know that it's there and understand what it is, at least, so that you can explain it intelligently to clients. So that's the kind of thing that if you wanted to get that deep on this with your clients and with the bookkeeping, especially if somebody like me is involved, where I am often analyzing a client's books month to month, then that's when you want to start doing this kind of thing.
Seth, I want to mention one thing that's really important here. That was awesome, Chris. Thanks for explaining it that way, because I wanted them to understand that there could sometimes be depreciation in COGS. But for me, what I want to point out here, something that Seth mentioned. So sometimes people wait for the tax professional to do the depreciation, but if you're trying to do tax planning, there may be situations where the depreciation, which is kind of known as a paper loss, because you're not actually paying out depreciation, but it's an expense on your books and on your tax return, you do want to check that out, because if you're trying to do tax planning and trying to project, tax liabilities, let's say that person is an investor now and they have long-term depreciation on their rental, then you do want to go ahead and put that depreciation in there, because you could be showing a big expense after you put it in, and without putting those in, let's say they own like 40 rentals, then you're really showing incorrect financials if you are trying to do like financial analytics or tax planning.
Right. And another thing that I think is important to understand about depreciation is, like Marriott said, it's a paper expense, but keep in mind what it truly is it's an expense that you're taking now based on something you paid for in the past, right? That's essentially what depreciation is, and what capital assets are is, I pay for something today. I spend $15,000 on a piece of equipment. I don't want to expense the whole thing, because I'm going to get the benefit of the use of that asset over a period of time, like 5 or 10 years or whatever its quote unquote useful life is. So the idea behind depreciation is we're saying, I don't want to expense that all at once, because it's not something that's going to be used up all at once. So I expense it in pieces over a period of time. Now, and then I notice Alexa mentions in the chat, some people will elect Section 179 and depreciate the whole thing in 1 year anyway. That's often done as a tax strategy so that people can get the benefit of the deduction when they might need it if they're very profitable in that year. So, and Alexa's pointing out that it does sort of falsely deflate the value of the business when you do that, because it doesn't really show the true asset value on the business. We've expensed the whole thing. So that might be an example of where you would have a difference from books to tax for depreciation purposes, where tax-wise you would do Section 179, but books-wise you would do more of a straight line over 5 or 10 years or whatever the right useful life is for the asset. That's a perfect example, and Alexa, thank you for bringing that up, of where you might want to have a book-to-tax difference on depreciation. All right, but we've already gone way too deep into depreciation, and I want to make sure we cover, the high-level stuff completely before we get too deep into things. So again, going back to what the sort of high-level specific expense lines are that are on the tax return, these are the things we have. So, again, we have depreciation. Depletion, most of you probably won't see too often. As you can see here, it has to do with oil and gas. If you have an oil company, it's kind of the same idea as depreciation in a sense, but it's being depleted rather than depreciated. Then we have advertising, and so this kind of gives you a clue that these are the things that, for whatever reason, the IRS has decided they want to single out and look at, right? Pension and profit sharing plans, any other employee benefit programs. Then you have other deductions, and it says attached statements. This is where everything else from your client's P&L will go to die. Everything else goes into other deductions. So you will find further down in the tax return a statement that lists that. This is the part that takes some time if you really want to go line by line, adjusting the trial balance from QuickBooks to agree to the tax returns. I don't bother because at the end of the day, and for that one purpose, all I really care about is that the net income agrees and that the specific line items that are singled out on the tax return agrees, especially salaries and things like that where there's a third-party document such as a W-3 that those things have to tie to. So generally speaking, when I'm adjusting the books to agree to the returns, I really only care about these line items all agreeing exactly to the tax returns. And then as long as the other deductions all aggregate such that the total deductions, right, lines 7 through 19 here, if they all add up so that I end up with the right net income, right? So line 21 is the equivalent of the net income line on your P&L from QuickBooks. As long as I end up with that number being right, and then we're going to get to the balance sheet in a minute, that plus getting the balance sheet to agree, your retained earnings is going to tie. It sort of has to by just way of the way the numbers balance. So we're going to get to that in a second.
Seth, really quickly though, again, for the bookkeeping professional, making sure they're covering themselves and, providing the best service, especially if they're using a tax professional, and they're all trying to work as a team. There's a reason why there's line items on tax returns that say parentheses attached statement. And it's just really important for you to know that. It's not so you can just bulk it in there and have it as one line and say, oh, but they have the QuickBooks and they can go back and look. No, there's a reason, because there's an area in the tax software that the tax professional is going to go and line by line itemize everything that's in deductions, which should mirror what's in QuickBooks. So if you were in an actual tax software, you would click on that line 19 and it would source back to an itemized list, which is called a white paper or a statement. So it's just really important that you know that, because let's say you got a new client and you want to check their books against their prior year tax return, and they usually would just say, oh, here it is, and they'll give you page 1. And you're like, yeah, but I see $550,000 on line 19. Where's your statement? Oh, I don't have a statement. I just have this. And you're like, no, you do have a statement, because you have to explain what that is. So just be mindful that when you see attached statement, it means there's actually another statement, a white paper itemized list of everything that's in that field.
Right. And like I said, when you get to this part, if you're trying to get it to agree, you will go to refer to that statement, because again, you want to make sure everything adds up and agrees to what you have on, in the books compared with the tax return. But at the end of the day, if I need to adjust something, for example, in order to just force the books to agree, and I'm not sure what to adjust, and I don't necessarily want to take the time to go through each line item that's on this statement, and it's not necessary to, because again, as long as these high-level things agree, what I'll often do is take whatever difference I might have and shove it into office supplies or something like that. Because again, at this point, we're talking about a prior year, getting it to agree to the tax return. I just need net income to tie out so that retained earnings ultimately ties out. But Mariette is absolutely correct. When like she said, if the client says, oh, I don't have this, the bottom line at that point, what I do is I say to the client, look, do me a favor, go back to whoever prepared your tax returns and ask them to send me the complete tax return. I don't even necessarily get into trying to explain to the client why I need it, because a lot of times that's going to give rise to more ways that the client can resist, so to speak. I'll usually just say, look, just get me the whole tax return, and I need this because, and what I will say to them is, look, your books don't agree to the tax return, and there's no way I can get them to without having everything. So please, I need everything. Otherwise, I can't do it. There's certain conversations that I don't feel are worth my time having with the client. I don't want to spend an hour explaining the whole tax return to the client. I just, again, will often say to the client, look, I need this, just get me the whole tax return, please. Otherwise, I can't move forward. So again, this is your P&L, right? We started with the gross receipts. We have all the stuff that you'll see on a P&L with certain specific things singled out, and everything else goes into other deductions where, like Mariette said, it's not that you're going to have a single line item. There's a whole statement here that has all the different line items so that you can actually clearly trace back how we got from what was in QuickBooks to what was on the tax return. The reason that things don't actually agree in most cases is because after somebody submitted the books to have the tax returns prepared, somebody went and changed something that affected that prior period, which is why we have closing dates that a lot of people tend to ignore, especially the clients. Okay, then I'm going to skip over this next section because this is strictly sort of technical tax stuff. I want to focus on the stuff that kind of is what we need agreeing to QuickBooks. So after we get past this one, and actually usually the first thing I go to before what we just reviewed is the balance sheet.
Actually, really quickly, one thing that you don't want to pass, Schedule B, please always want to look on the tax return if you go to the top of Schedule B, whether they are cash or accrual. That is critical, especially if you're engaging this client for the first time and they're existing, whether they've been filing as cash, right there, ABC. So cash, accrual, maybe a hybrid accounting method. And so that's really important for you guys to be aware of that. Obviously, we all kind of talk about that we like to always look at QuickBooks on the accrual basis for financial reporting, but you want to make sure that when you're working with the tax preparer, I mean, obviously they should know that, but you're going to be providing financials on the cash basis. So
right, and most of your clients are probably filing taxes on a cash basis. The exceptions might be companies that deal with inventory. Inventory almost by default triggers an accrual basis need because inventory by its very nature is an accrual basis thing, although you will see some inventory businesses that file cash. It's just a little weird because it's kind of hard to have inventory and cost of goods sold on a cash basis. But anyway, Merritt's right. This is one thing you should check. And sometimes I'll ask the client, do you file on cash or accrual? And some know, some are like not sure. So this is where you can double check, how they did file is, when you get that last year's return from them, you can go here. Now going to the balance sheet, again, it looks different, but the concept is the same. And what gives it away is the fact that right here you see assets and it actually says balance sheets per books. Now, this is broken down into 2 major columns and then 4 subsidiary columns. So the first 2 columns here on the left side here are the beginning, which is really the year before this tax return. So what you want to focus on when you're trying to get the books to agree, for example, is here where it says end of tax year. So if I'm looking at a 2015 tax return, these would be the 2015 year-end numbers. Right? Now, cash obviously is going to be all your bank accounts added up. The other thing to keep in mind, undeposited funds really is cash, right? So in theory, you need to add undeposited funds to that to get the true right cash balance. I don't honestly know that a lot of, I want to be careful choosing my words here, but I've seen a lot of cases where the person filing the taxes perhaps is not so well versed in QuickBooks and they don't really understand what undeposited funds is. Undeposited funds, let me ask you guys this, Marriott, Nicole, and Chris, the tax preparers, that I talk to probably most often. Would you think of what's in undeposited funds as constructive receipt?
Absolutely, because most likely it's not even undeposited funds. It's funds already in their bank and they just haven't done the process yet.
Right. Or the checks are sitting on your desk and haven't been taken to the bank, but that's still definitely constructive receipt. You've got the money. You just didn't walk it over to the bank yet.
Yes, sir.
So again, and if you ever analyze it, and this is where I picked apart the statement of cash flows years ago and learned this, excuse me, when you run a statement of cash flows, you might find in some cases that the ending cash balance on the statement of cash flows does not tie to the total of the bank accounts on the balance sheet. And when it doesn't, it's because you have to add undeposited funds to the bank account balance on the balance sheet, and that total will always agree to the statement of cash flows, unless you've got data integrity issues. So again, I know I drove the point home hard, but we have to realize that undeposited funds is cash. It's money you're holding, it's in your pocket. Even if it's credit cards processed that haven't funded yet, they've been processed within the last 2 or 3 days, unless something very unusual happens, that money's coming into your account. So that's what cash is, right? And everything else is going to be pretty straightforward in terms of what you see on your balance sheet. You have your accounts receivable. You have, less allowance for bad debts is something you might see a little less often, for small businesses, but it's there and it does come up. Here, of course, is your inventory. They separate out any U.S. government obligations on the asset side. So this would be, I guess, like receivables that you have from the government. Let's say you're in the real estate rental business and you have, the housing authority who's subsidizing rents. That might go here, I suppose. tax exempt securities. Again, these are just assets where you would literally go from the balance sheet to this, and most of this should line up kind of line for line. Loans to shareholders, right? Mortgage and real estate loans. Mind you, this is the asset side. So this would be if you're in the business of lending for real estate purposes, that these are monies that are owed to you, right? If you're paying a mortgage, that's down here at the bottom under liabilities. So really important to understand what planet you're on. Right now, we're in planet assets. So when we look at mortgage, that's a mortgage receivable or a real estate loan receivable. Any other investments? If the company has a lot of cash and invested in the market, money markets, other securities, that's going to show up here.
Actually, really quickly, this is really important for them to understand, and I like that you brought that up and what planet you're on. And I mean, we're not saying that in a bad way. We're saying it in a way where, let's just say that it's an S Corp. Like Chris said, most people are an S Corp because they'll get a professional that says be an S Corp, and unfortunately, everyone just thinks that's what they got to do. But there's reasons why you become an S Corp. That's a whole different session. But the point is that, so then they start loaning themselves money, and, it's to and from, back and forth. So you got to tell them, depending on if that number is positive or negative, whether you loan the money and the company owes you, or whether you got money from the company and you owe the company back, remember where you got to put it in the right place. So obviously, if you loan the money and the company owes you, then it's a liability for the company. But if a company lent you money and you owe the company back, then it's a receivable for the company. But the most interesting part, guys, is because you and the company, meaning the S Corp and the company, are the same because they're the same person, but they're not the same because they're an S Corp, so they have to be identifying themselves as different people. So it's really hard for them, because if they were a sole prop for 20 years and they just turn into an S Corporation, they still think they're the same, but they're not. So you got to explain that to them. Like, okay, what is this really? Is this you lending the company money? Is this the company lending you money? Let's make sure we put it in the right place. Why? Because when we report it to the government, we want to make sure we're reporting it to the government in the right place. And this is why it's so important that we tie the books to the return. Remember, you're reporting this to the IRS. The IRS can now go back and say, hey, you said it was on line 7 and it wasn't not on line 19. I can pull up your tax return and prove it to you because you put it on your tax return. So now it's in black and white, guys. Now you can't say, oops, I didn't do it, because you did.
Right. Yep. And interestingly enough, along these lines, and this is where I'll give, frankly, a rare plug for Xero. Xero has an option that you can set where it will kind of analyze what the balance is. So if you set up a loan to or from a shareholder as, let's say, a liability, because let's say most of the time that's the way the money goes, that they're loaning money to the company. So from the company's perspective, it's a liability. They owe it back to the owner or shareholder. Some accounting software now is sort of catching up with the reality of what goes on with these things. And so if that liability goes negative, it'll automatically flip it over to the asset side on the balance sheet when you run the report. So, and that's really cool. So that's one really thing. Really, I have to give Xero props for that, because that's a really cool feature that Xero does. And there are a couple others that do it. Unfortunately, QuickBooks Online does not do that, but maybe it will soon. So that way you don't kind of have to worry about, is it loans to shareholders or is it loans from shareholders, right? That's the distinction between whether if it's an asset, it's a loan to the shareholder because it's owed back to the company. If it's a liability, it's a loan from the shareholder because it's owed back to the shareholder. So real quick then, if we continue down, you'll see that this very much mirrors what we see, in the balance sheet in QuickBooks. We have fixed assets, which is your buildings and other depreciable assets. And then here's your accumulated depreciation. Then depletable assets and accumulated depletion goes back to what we looked at up above, where we have depreciation and we have depletion expenses, right? Then here's where we have land. Land technically should be separated out from the value of the buildings that we show. A lot of people don't bother to do that. But the reality is, if I purchase a building, I'm supposed to separate out. I'll have, 123 Main Street as the fixed asset. Within that, I should have land at its value and then the building with its own separate original cost. And the reason for that is because the land usually appreciates while the building itself depreciates. Then we have intangible assets. This would be things like goodwill that may have been produced when we purchase another company, and things along those lines, or organizational costs and, other things that are considered intangible assets. And then other assets is your catch-all for anything that really doesn't fit into any of the other categories above. And of course, then you get your total assets. So the first thing I do when I'm trying to tie out the tax return to the books is I add up the total assets from here, or I look at the total assets, right from this line 15, and I look at the total assets line on the balance sheet of the QuickBooks file and ask myself, does this agree? If it does, fantastic, I can probably move on. And I usually jump right down to, well, then does total liabilities agree? It's if total assets and total liabilities agree, then I'm probably good with retained earnings. But keep in mind, this last line 27 is actually the sum of total liabilities and shareholders' equity, right? So be careful. Again, it's important to understand what planet you're on, because we have to make sure that we're comparing apples with apples. And so here's other liabilities right here. And notice the tax return does not separately total the liabilities. So you have to do that yourself, because it goes from other liabilities right into equity, which is capital stock, additional paid-in capital, retained earnings, any adjustments to shareholders' equity. Notice if that exists, then we have to attach a statement which is going to detail where that came from. Less the cost of treasury stock. That's not something most of us as bookkeepers for small businesses will ever have to deal with. It's more something you'll see on a publicly traded company, but obviously it can happen or it wouldn't be here on the tax return. And then we get the same total here on the tax return balance sheet that you'll see at the very bottom of the balance sheet in QuickBooks, which again, we have total liabilities, and then we'll have equity, and then we'll have total liabilities plus equity. So it's really important to get each section tied out. Even though there's not a separate total liabilities in here, figure in the separate total liabilities on a worksheet on the side so you can make sure, because what happens is when it's off, and it usually is, you want to know, where am I off? Am I off on the assets? Am I off on the liabilities? Or am I just off on retained earnings? Because if you're only off on retained earnings and assets and liabilities tie, then likely the only thing that's off is something somewhere on the P&L. It kind of has to be that way when you've ruled out everything else. That's the only way you can only be off on retained earnings. In most cases, you're going to find you're off everywhere. You're going to find that your assets don't agree, your liabilities don't agree, and your retained earnings don't agree. So then the first thing to do is kind of check line by line, go down the balance sheet. Check that your cash agrees. If you're, and again, that's where my trial balance adjustment template comes in, because it lets you key in the numbers from the tax return. You can drop your trial balance report right in on the other side, and the template that I've created, I've written formulas that figure out what you need, debit or credit, and how much to get from what was on the books to what was on the tax return. And when you go through that process, it's almost magical. It just kind of forces it to balance. When you post it, sometimes it may not even look like it's going to balance, but at the end, when you actually prepare the entry and you hit save and close, you run the balance sheet and it's like, holy crap, it agrees to the penny. So that's why I developed it, because I was spending hours trying to go through this and all the related schedules. Now, I want to quickly jump down to where those schedules are, because you're always going to find them. But of course, this sample doesn't have the schedules. It's just the basic form. Marietta, Chris, any way you can bring up and share your screens and show us an example? We have like 2 minutes left, but I would love for everybody to see what those schedules look like.
Chris, you got one? Because I know you're the S Corp king. Is he still there? Is he gone?
When you say schedule, Seth, what kind of schedule are you talking
like the
about?
other deductions, that schedule.
Oh, like the attached schedule?
Yeah, and you know how you'll have statement 1, 2, and 3 usually with all the different breakdowns of the high-level things.
I'm looking for one too, real quick. And then while we're both looking for one, I wanted to answer a couple of questions. So Michelle mentioned, is Schedule B, which is second page, is it mandatory? So you guys, what's really important with the tax return is that, and again, Seth mentioned it in the beginning because it happens to so many times, usually a client will just kind of say, here it is, and they'll probably just scan the first page and they'll send it to you. But every tax return should have, at the bare minimum, even if it's a zero tax return, because remember, if they started from the beginning, they only have maybe the $800 minimum tax in California, they have to have at least the first 4 pages. That's why Seth went over the first 4 pages, because the 2 pages that he didn't go over, except for, the cash versus accrual versus hybrid question, those are questions that are critical for them to answer, because they're telling the government already things about their entity. So page 2 and 3 of the 1120S are critical. So there's no way they cannot be completing those pages. And they can't just say, oh yeah, all I did is send page 1 in. That's impossible. It's a complete tax return, and they have to complete it all.
And you guys, Have I
Yep, we
requested?
can see your screen now. Perfect.
Yep, this is exactly it. Awesome.
So yeah, I mean, it's what you would expect. Probably it's everything that's not able to be put into the first page of the tax return. There are definitely other items that we didn't have time to get to. Schedule K is kind of an interesting schedule where something like a charitable contribution, it doesn't go in here. It goes in a different place. The client still gets benefit from having made those contributions. It's just they go in a different place. So when you see something like this, you may on your P&L have charitable contributions somewhere as a kind of a typical expense. A good way to treat that might be moving it down to other expenses, just so you're segregating it out a little bit. The non-deductible expenses, this is again something that comes from the Schedule K. Because meals and entertainment is only 50% deductible, you end up with a portion of meals and entertainment that is non-deductible. And then other items here, it's okay to show this. This is a company that's no longer in existence, so it is what it is. But security deposits, again, you can see things coming through on the M2 schedule. This one was something that had a cost of goods sold and purchases, a calculation there. Remember the 1125A. I think that's what you wanted to see, isn't it, Seth?
Yeah, just so people can see that this is, when you look at the high-level numbers that we did go through from the two primary forms that I look at, one is that first page, which is essentially your P&L, and the other one is a few pages in, which is the balance sheet. When you go through these forms, you're going to see comments like Mariette pointed out that say attached statement, or on the balance sheet, you're going to see Schedule 1 or Schedule 2. They're numbered, and that's how like the big one is the other deductions. So this is all the stuff that isn't separated out specifically on its own line item in that first page of the tax return. But notice this is the stuff that essentially can get keyed right off the client's P&L. And it's line by line, so this can always be tied back to the P&L, so you can always find out exactly where you're off if you need to. Like I said, the first thing I do is make sure that the specific line items on that first page tie out to the penny. And then if there's any difference remaining in net income after that, then I'll just take one of these line items from here, right, from the line 19 other deductions detail here, and I'll usually pick the one with the biggest balance and stick it there so it's the least sort of percentage impact. That's usually how I play it. I won't touch meals because that's got, as Chris pointed out, a 50% deduction. And so I'll generally hit like an account that's got a big dollar amount in it in order to just adjust for any difference, because at that point within the details here, I don't much care, nor do I think anybody else does or should, as long as I can get the net income to agree, because that's what ultimately flows to the retained earnings. So that's what I need to do ultimately to get retained earnings to tie, is I need net income to agree in total, I need assets and liabilities to agree, and then I need equity within that in terms of the distributions and other components within equity. As long as those all agree, when everything else agrees, retained earnings sort of is forced to agree. And that's what it comes down to for our purposes as financial accountants or bookkeepers, I think, at the end of the day. And also having this understanding, I think, goes a long way for you to have a better working relationship with your client's tax preparing professional. And you'll get, frankly, more respect from them than you might now, as far as them regarding you as somebody who actually understands what their needs are and is actually working to help support that. And I think that's important, especially as we move into the future and our role becomes more strategic in nature. It's less data entry, it's more analysis, and it's more just kind of managing the flow of information and making sure things do get to the right place, making sure things do show up on the right line items. And I think now, hopefully, you've seen it very clearly underscored why it's so important that things really go to the right place when we're recording the transactions for our clients. So anybody before we run, any questions, comments, feedback, thoughts?
Hey, Seth, I have a video that goes over the reasons for forming different entities, and I will send that link over to you to where you can take a look at it. And if it's something you want to disseminate, some of the chatters have said, would love to see a video of why you do S Corp versus LLC versus sole prop, that kind of thing.
Yeah, and I would love to have you back on one of these calls, Chris.
Yeah, we can do that too. I mean, I have quite a bit of easy to understand stuff of where to recommend what and why, and how to quantify some of those recommendations to where the client understands why they're doing it.
Yeah, so you know what? Let's do this. Once I get the video from today posted, I'll post the link, of course, in the Between Wall and Man group on Facebook, and then just post the video link in that thread.
Sure.
That way people know where to go to find it.
Sure, absolutely.
And then Alexa's asking, so, when there's that 50% different for meals, so that is a return difference, a book to tax difference. You'll find that on Schedule M1. So sometimes I get asked that question from bookkeepers is, oh, do I need to do something about the 50%? And the answer is no. You record for financial bookkeeping purposes the full amount of the meals. And then the tax preparer knows that they have to take that and divide it in two so that you only get half of that amount deducted for tax purposes.
Friday, 11:06.
Okay, someone's listening to their voicemails.
Yeah, I was going to say, so somebody's, it's 11:06 somewhere.
All right. Well, this was awesome, guys. I actually have a client coming in. This was amazing, and everybody was really happy with it. Seth, thank you for having us in there. And I think the Chris, Seth, Mariette show, honestly, magical. I will do this any day, all day long.
Well, yeah. So, Chris, let me know when you can come back and do the subject of how we choose our entities and why. I think that would be a great topic.
Absolutely. Sounds good. I always enjoy it.
All right. Likewise. So I'll see you all later. We have Gina's Hangout today, 2:30 Pacific, 5:30 Eastern. Gina, go ahead. Give us the details.
It's just an open session. What you see is what you get. Come and talk about what's happening this week.
All right. We'll see you there. Oh, by the way, in case you missed it, we have a new president.
Oh, and Seth, even more important, have a good class today.
Yes, my second Excel class at Santa Monica College.
Yay!
Good for you, Seth.
All right.
Thank you so much.
All right, guys. Thank you. Bye. Have a great day.
Bye.
Bye, everyone.